In this week's update, it's been a busy week at the world's central banks. There's been new highs for US shares as Trump's tax bill looms, plus a mega deal in the world of media. Last week saw the results of the final meetings this year of monetary policymakers in major markets, with the path for rates and quantitative easing seemingly set as we enter 2018. In the US, the Federal Reserve made its third rise to rates this year, taking the target rate for federal funds a quarter of a percentage point higher to between 1.25 and 1.5%. The Fed confirmed that its best guess forecast for rates from here is another 3 rises next year and 2 more in 2019. That is based on its assumption that growth will continue, something that appears to be supported by robust US jobs data, which shows that the unemployment rate in the world's largest economy as being just 4.1%, which is near full employment. The Fed's prediction 3 years ago that GDP growth this year would hit 2.4% has been proved eerily right. For the Fed's outlook on rates to become reality from here, however, inflation will have to pick up, and here it is where many observers diverge from the Fed's view. Inflation in the US has remained stubbornly low, and that has caused 2 of the Fed rate setters to vote against a rise this time. Overall, though, the consensus is that the US economy is in good shape as 2018 arrives, and you can expect praise to be heaped on departing Fed Chair Janet Yellen when she leaves the post next year to be succeeded by her Fed colleague Jay Powell. The Fed is thought to be much further down the road towards normalisation of monetary policy than its counterparts in the UK and Europe, of course, but last week brought further evidence that these two are making progress. First, the Bank of England confirmed that rates will stay on hold at 0.5% after the first rise in more than a decade last month. Importantly, the Bank of England suggested that it saw no reason to change forecasts made in November, that UK rates would rise, quote, gently from here. The market view that there will be just 2 quarter-point rises over the next 2 years was, the bank said, consistent with its expectation that inflation would return to its 2% target in that time. On both sides of the pond, then, it is inflation that remains the crucial metric as we enter the new year. In the UK, last week also brought confirmation that the official CPI inflation rate has now reached 3.1%, which the Bank of England believes will be a peak. Over at the European Central Bank, the attention won't be on headline interest rates for a while yet. Rather, the ECB is focusing first on turning around its giant bond buying programme, its version of quantitative easing, of course. The ECB repeated last week its promise to continue the programme until September next year and kept rates on hold. President Mario Draghi faced questions about losses suffered by the ECB after some of the corporate bonds bought under the programme were downgraded to junk status. The bonds in question were issued by Steinhoff, a South African retailer which has run into trouble and was unable to release financial results last week after a potential €6 billion hole was found in the accounts. The ECB extending its bond buying to corporate debt is controversial and has had unforeseen effects on markets. One example of that is the convergence of yields on investment-grade debt with those of sovereign debt, as investors take on more and more risk in order to achieve an income. Stock markets have also been distorted by central bank policy, of course, and they remain elevated. Last week saw yet another high for US shares. At the time of writing, the S&P 500 was just off its top at 2,675. The FTSE 100 was at 7,528, and the Euro Stoxx 50 was at 3,602. Those highs for US shares have been driven by optimism that a pro-corporate tax bill will be signed off in time for Christmas. Like much else under this president, the tax bill is controversial. It proposes reducing the main US corporation tax rate from 35% to just 21%. Those companies with high exposure to the domestic US market, therefore, are expected to benefit the most, including oil refiners, railroads, airlines and banks. Another element of the bill would see the introduction of a 15.5% tax on money earned and held offshore by companies. Even here, though, the bill is friendly to business because much of this money would have to be repatriated at some point anyway and would have faced taxation at higher rates at that stage. So the new tax is beneficial versus that scenario. Apple, for example, is expected to reduce its potential tax liability by $47 billion as a result of the bill. In currencies, the pound lost ground over the course of last week, but recovered slightly on Monday to reach $1.3354, and against the euro, 1.1327 euros. Movements in the pound were influenced last week by news on Brexit, with the EU finally agreeing that it can now move on to the next phase of talks with the UK about the country's exit from the Union. The next big news is likely to be a declaration by the UK government of its preferred end state for the UK vis-à-vis the EU. In simple terms, the possible scenarios now seem to have settled and sit on a scale between two known potential outcomes. Either the UK will become like Canada in its relationship with the EU, or it will become like Norway. A Canadian version would see the UK get the regulatory divergence, including on free movement of people that hard Brexiteers want, but potentially at the cost of more limited access to the European market, particularly for services which dominate the British output, of course. A Norwegian scenario, on the other hand, would offer much better access, but would mean signing up to more of the EU's rules and could preclude the negotiation of separate trade deals with other parts of the world. Theresa May says that she wants the best of both these worlds. The EU says that's impossible. One thing to watch in all this remains the Irish border issue, which remains unresolved despite the progress of talks and could push the final deal towards the more Norwegian end of the scale. That's because regulatory divergence under a Canadian-style deal would potentially require a harder border on the island of Ireland, something the UK has promised not to impose. It needs to come up with solutions to that, otherwise it may have no choice but to opt for regulatory alignment and a Norway-style deal. Oil prices remain elevated after news last week that the Forties pipeline system, the main system for carrying North Sea oil, must now be shut in order for repairs to be made to it. As a result, benchmark Brent crude rose to above $65 a barrel last week, a level not seen since the summer of 2015. Elsewhere in commodities, gold is at $1,256 an ounce. Finally, the major company news of the week came in the media sector and was the news that Walt Disney is to pay $66 billion to buy film, television and international businesses from Rupert Murdoch's 21st Century Fox. Under the deal, Disney will acquire Fox's film and television studios, its cable entertainment networks, as well as its international TV businesses. The deal represents the coming together of two giants of old media to take on, they hope, the giants of new media. Amazon, Apple and Netflix have all shown they see content creation as their next big target, taking yet another slice of the value chain from traditional operators. Disney and Fox will hope that their combined stable of copyrights and intellectual property can stand up to this challenge. That's it for this week's update. Enjoy your week and a happy Christmas to those celebrating.